Welcome back to Global Money Talk, live from the New York Stock Exchange. This week in our Market Insight segments, we've been focusing on the tech sector. We heard from a slew of guest speakers and honed in on MSPs, analyzed different sectors, and also explored the different cycles of the tech revolution. And we were also joined by Dan Ives at the beginning of the week for a deep dive into cyber and some Mag 7 names. Well, to wrap up our tech week, I'm joined by Dan Ha, partner at Karani Asset Management. Happy Friday to you, Dan. Thank you so much for joining me.
Happy Friday. Thanks for having me.
Well, we're wrapping up the week of market insights that focused on tech. But before we talk about everything we've learned and focused on this week, let's take a look at economic data, especially on the heels of that jobs report.
Yeah. So until last night, frankly, I was getting a little nervous. Last week when I was here, I talked about the tail risk of inflation reaccelerating and the Fed needing to fight that if that were to happen by raising rates. Again, a low probability outcome, but something that would hurt nevertheless because it's such a low probability outcome and that is not expected by many. All events have triggers. All bad events have triggers. They usually start small somewhere and become bigger. And a combination of a major port strike and a potentially escalating conflict in the Middle East that could drive energy prices higher. The combination of that would have been bad for inflation and potentially could have rekindled inflation higher. Now, to be fair, I don't think the port strike was ever expected to have a really bad impact on the economy, at least in the near term. However, psychology matters when it comes to inflation. Even though, for instance, people were talking about toilet papers, right? Apparently something like 90% or more of the toilet papers that we use in this country are produced domestically, and what is not produced domestically is imported from Canada and Mexico, which means that the port strike would mean nothing to the availability of toilet papers, yet people were still talking about it. Why? Because the memories from 2020 shortages are still fresh in people's minds. So, you heard of people, friends of ours going to the grocery store to stock up because, now there's a port strike and, we don't know what that might mean. And, literally a friend of ours was at Costco like 3 nights ago and apparently line was out the door.
Oh my goodness.
So even though, analysts might think, okay, it's the East Coast ports. What are we importing from Europe? Like, how would that impact our daily spending and our daily necessities? The general public is not always going to be thinking about it that way necessarily. Therefore, this could have been the thing that rekindled inflation, especially if it coincided with rising energy prices. But fortunately, that risk went away as of last night, at least for now. And when it comes to energy prices, the risk of further escalation in the Middle East still is very much going on. But at this point, that alone probably isn't going to be, higher energy prices alone probably isn't going to be enough to, reignite inflation or reaccelerate inflation. Therefore, I basically said all of that to basically say that I feel about the same about equity markets and the macro drivers. I feel about the same today as I felt last week, but I still thought it was important to kind of share my thought process to help remind the viewers that you always probably want to be thinking about where could things go wrong. Just briefly on the labor market. Ty did such a great job recapping it, and not just today, but this entire week. I don't really have anything to add. other than to say that on balance, it does seem to indicate that the economy is still quite strong, that the labor market is quite strong, which is a good thing. You know, I'm generally an optimistic person. You know, when I come here, I talk a lot about the things that could go wrong. So it may sound like I'm pessimistic, but all I'm trying to do is, you know, help our viewers think about the things that they may not be thinking about. But to be fair to myself, I'm a pretty optimistic person, a pretty positive person. So strong job market, therefore strong economy. You know, it's something that I like to see too, so we'll see.
And I do think it is very helpful for our viewers to know what you're paying attention to, not just in terms of economic data, because some of the things that you mentioned, the port strike as well as tensions, unrest in the Middle East, they have the potential, as you mentioned, to affect so many parts of the U.S. economy. But for now, at least the port strike has ended before it extended into the latter half of this month, and we will be getting some inflation figures out from the U.S. next week. So we get CPI as well as PPI, so we'll get a better read on the latest figures out from that data point. But shifting our focus back into what we mentioned earlier, we focused on the technology sector. For our Market Insight segment this week, we had 4 days of tech specialists covering a variety of topics. So now that we're here on this Friday and we can take a look back at what we covered this week, what stood out for you, Dan?
Sure. So starting with the first 2 days, between Dan Ives and Serge Boucard of Atlas Technica, we heard a lot about vendor consolidation in software. I mean, I asked a lot about vendor consolidation because, frankly, it is a theme that we are focused on at my firm, Karani Asset Management. And basically, they confirmed that view, our view, that vendor consolidation is very much underway. I don't know any business buyers of software that actually love having more and more vendors to manage. You know, if they could, they'd like to have fewer. And some companies, like both Dan Ives and Serge mentioned, have to have lots of vendors. I mean, often these are very large enterprises that have a large IT department to enable that, to support that. So they could afford to have that. And second, these larger places will often, from a business risk management standpoint, require that they use multiple vendors rather than, you know, more vendors than fewer. But that doesn't mean that they actually love using multiple vendors. It's just more to manage, more to integrate, clunkier experience for the end user. It's just not great. And nowadays, we even have software that help you manage your software, right? I mean, do we really need that? I mean, in certain situations, certain contexts, I'm sure you do. But generally speaking, it's not something that I don't think corporations, enterprises do happily. It's just something that they do because they have to. So vendor consolidation, we think, is something that is going to continue to happen. And that sort of adds to the general view that we have had of being cautious about smaller point solution type software companies. Because when you're a smaller point solution type software company, you have what we internally kind of nicknamed the Microsoft risk. It's the risk that you wake up one day and suddenly Microsoft decided to focus on your area of the business and starts competing with you. That's existential. No matter how, it doesn't matter how low a multiple you trade at that point. If you have a major competitive threat from a very large player that has large distribution capabilities, then that's existential for you. So, you know, that's something that I would take away from the conversation. There is one, a set of statistics that I'd like to mention when it comes to this. So out of about 130 US software stocks, the median market cap of the most highly priced 1/3 currently is about 14 billion. The median market cap for the lowest priced 1/3 is about 2 billion. So that's a 7x difference. That same measured about 10 years ago. For the top 1/3 most highly valued software company, the median market cap was actually 1.8 billion. And the same for the 1/3 lowest valued software companies was 1 billion. So a difference of 1.8x. 7x, 1.8x, meaning that spread has widened over time. So 10 years ago, whether you were highly valued or you were valued low as a software company wasn't necessarily about size. Today, it is definitely, I'm not saying that that's the only driver, but there's a big component in what is driving the valuations of software companies. A major component is how big you are. Because the bigger you are, the more established you are probably, and it's probably harder for a competitor to try to come in and just squash you and just decide to compete with you. So that was a major takeaway that I'll be applying in our process.
And also, Dan, in addition to what you mentioned with vendor consolidation, we had other speakers this week, and we were able to take a closer look at some of the bigger market cap names, including Alphabet. We had Shweta from Wolfe Research, and she was not so bullish on this name. What did you make of that?
Sure. So Alphabet, we actually think it presents a rather attractive risk reward right now. So for full disclosure, we own some Alphabet at my firm. Alphabet is largely seen today as a laggard, or a laggard in AI, and it's seen as being challenged by these newcomers in the Gen AI space. And the thing about Alphabet, as Shweta correctly assessed, for Alphabet, it's kind of like heads you're flat, tails you lose. Alphabet is a champion currently, right? So if they figure out AI, the best they'll do is hold on to its sort of champion position. I mean, that's what's tough about being at the top, right? The best you can do is hold on to your position, and if you can't defend it, then you've only got downside. So Alphabet is being challenged. There is this new technology wave of generative AI. Alphabet is, I think it's fair to say, still seen largely as being behind in that race. Therefore, the worries are, I think, warranted. Having said that, I don't think Alphabet stock necessarily is reflective of that, meaning heads you win, or heads you're flat, tails you lose. From our previous conversations, I like situations where it's heads you win quite a lot and tails you lose a little bit. Alphabet stock right now, even though the business is heads you're flat, tails you lose, Alphabet stock has derated in recent months in recent period because of these fears, and therefore is already incorporating some of that pessimism into the stock. So for example, Alphabet historically over the last 7 to 10 years have traded at about a 40% premium to the S&P equal weight, which is our preferred index to gauge the broader equity valuation levels. It has traded at roughly 40% premium on average over the last 7 to 10 years. That premium has come down to about 13%. So clearly, people aren't as optimistic about the future of Alphabet as they were a few years ago. And that clearly reflects this pessimism, this concern that the market has, which means that if Alphabet could actually hold on to its position by figuring out AI, we think the stock actually re-rates higher because it'll take away the reason for all the pessimism around the stock. And so, we actually think it's quite an interesting risk reward at this point. And just in terms of Alphabet being being behind in AI, I think the jury's still out. I mean, if Dan Ives is right, who says that AI is a party that goes till it's 9 a.m. at a party that goes till 4 or 9 p.m. at a party that goes to 4 a.m. That means we're very early, right? If we're very early, I think it's too soon to say, well, Alphabet is behind. They're certainly not sitting still. They're certainly working on a lot of AI capabilities, have been for a while. And recently they've launched some really cool Gen AI capabilities, like, for instance, Notebook LM is something that we internally have recently been experimenting. It's a tool, it's a very useful and impressive tool. So that's one example. Another is, I think it was actually yesterday, announced some ways to place ads alongside their AI search results, or Gen AI generated search results to help the ad business so that they can continue to monetize the Google platform. So I think I think it's still way too early to tell. And on this point, one other thing I want to just kind of mention is the thing that I pay more attention to than even the immediate monetization opportunities, frankly, is the strength of the user base. Because as long as they have that strong user base, we think long term they'll have plenty of opportunities to monetize that user base. I use ChatGPT and Perplexity in my work, in my day-to-day. Therefore, that's one less search that I'm doing on Google and on ChatGPT and/or Perplexity. Having said that, I haven't left the Google ecosystem. The Google ecosystem is so deeply, in my life that it'll be a long time before I leave that Google ecosystem, between Gmail and, all the Google products, right? And I have two small children in elementary school. They're learning how to use Google at school. Their school is basically, they use Google Classroom and Google G Suite to run a lot of their day-to-day. And one of the first, actually the first computer project that my daughter had when she was in first grade was to use was to collaborate with a classmate using computer, and that was done on Google Doc, right? So she was telling me about how she knows how to use Google Doc and things like that. So, I mean, talk about an install base, right? They're working on this. They're continuously building their user base, and it's not just my daughter and my son's school district. I don't have the latest number, but as of 2017, the number was close to 70% of all the school districts in the country were using Google Classroom or G Suite in school. And I wouldn't be surprised at all if that number was higher today. So as long as Google continues to build this very strong and robust user base over the long term, I think they'll have plenty of opportunities to monetize. Now, on the downside, if they fail at that, the downside I don't think is going to be, if Google dies, I don't think it's going to be a sudden death. I think it'll be a very slow, drawn-out death because of the strength of the user base and the strength of the install base. Therefore, hopefully, if Google fails, as investors, hopefully we'll be able to jump off that ship before it's too late, and before the decline is detrimental to the portfolio. So we're monitoring closely, but the risk reward seems rather attractive in our view.
Well, it seems as though we're seeing a common thread here, whether we're talking about enterprises and vendor consolidation, or even consumer personal usage of some of these platforms, that convenience and staying within one ecosystem can be easier when we're trying to juggle different things.
Right.
So, Dan, speaking of new technologies that are also challenging today's champions, we heard from Steve Milinovich Vic, who brought his multi-decade experience to share his views on where things stand. So what were some key takeaways, and what are some things that stood out for you, Dan?
Yeah, no, I thought Steve's interview was awesome. You know, there were so many things to take away from that, but if I have to pick, I'll pick two things that kind of tie into what I was talking about earlier. So the first one is, you know, he made a reference to a number of slides made and posted by Coatue, which is a very successful tech investor. And I actually brought some slides that that Steve used. Can we pull up slide number 1, please? So I'm not copying Steve. You know, it's just easier to visualize when you have charts in front of you. But so this is the S-curve that he showed. Again, work done by Coatue. This is available on Coatue's website if anyone wants to go take a closer look. But even though this one in particular is specifically about AI, it's an AI S-curve, I think this kind of S-curve applies to many different technology waves. And if we actually pull up slide number 2, these aren't quite S's, but here you can see the beginning, the rise, the decline of various waves. And the key thing to note about these various waves is the fact that they overlap, or they usually overlap. And so the beginning stage of the next wave usually coincides with the decline stage of the previous wave. And if we pull up slide number 3, these are the long-term stock prices of software and semis. And while the lines aren't as smooth as the previous, you know, they're conceptual charts, right? These are real price charts. You can see the beginning, the rise, the decline of the purple line, and then you could see the rise of the blue line. You know, Steve talked about the 10 to 15 year cycles in tech, and I could remember 10, 15 years ago, all the conversation around cloud computing, the build out of that infrastructure, and software companies that have up until that point were selling perpetual licenses to be deployed on-prem, were converting their products to software as a service products. And so, you know, here we are 10, 15 years later. It's impossible to know whether that purple line, which is a price index of various software companies, we don't know if that purple line is going to rebound upward from here, but it does seem to, so far, have followed that S-curve within the 10 to 15 year time frame that we saw in the previous slide, and that just adds to the cautiousness that I have when it comes to trying to pick winners and losers among the smaller point solution software companies of today. And so, you know, that was a very helpful insight that he shared with us. One other thing I'll share on this is if we could actually pull up slide number 4. If among our users, if they want to pick stocks within the smaller point solution SaaS type of companies, I think picking from the virtual software companies, the vertical software companies is probably better than the horizontal software companies, often called stack players. And that's because vertical software companies are the kinds of software companies that are supplying products to usually to a specific industry. So, you know, an example is a company that sells computer-aided design software, CAD software, for engineers to help design airplanes, for instance. Not all industries are going to have or are going to use CAD software, right? The opposite of that, like a horizontal play, would be something like an HR software or a marketing software or a communication software, which is something that basically all the businesses need. But what's interesting about this is if you look at that chart, the dark blue line is actually the valuation multiples of vertical software, a group of select vertical software companies, and the light blue is a group of these sort of horizontal software companies. And the vertical software companies are valued more highly right now than the horizontal companies. And that's interesting because if you think about it, the vertical software companies typically, typically speaking, have smaller markets because, like I said, not everyone needs CAD, but everyone needs HR software. And they're usually slower growing because more often than not, they have already penetrated pretty deeply into their respective markets, into their respective industries. So you have a situation where a slower growing and a company that is growing slower and has a smaller market that is valued more highly than a company that is potentially faster growing and has a way larger market. And that's probably because the vertical software companies are seen to be more safe, as safer than the horizontal software companies. And normally, when I'm looking for companies to invest in various industries, lower the multiple, generally speaking, the better. That means lower expectation, therefore higher upside potential. And if we're talking about more sort of slower moving industries like consumer staples or chemicals or industrials. If I see a company whose multiple has really collapsed, I would actually get pretty excited and want to learn more about it because it's more often than not cyclical fears. But in the case of these smaller software companies, the threat could actually be existential, coming from some of these larger companies equipped with Gen AI capabilities. Coming for your business. And when the risk is existential, then there's really no multiple low enough to really compensate for that risk. So this is something that I thought was a helpful insight shared by Steve. And just the last thing I'll mention about the second thing that Steve shared that was important to me, at least, was his assessment that the mega cap tech companies, the Microsofts, the Amazons, the Metas of the world, weren't behind when it comes to investing in the next wave. That they're actually doing a good job, and in fact, they're even leading in terms of investments into these areas. In technology and in many places, usually it's the largest players, the champions of the winners of yesterday or the last wave, that get disrupted and get dethroned. And so it's easy to think that, okay, this is the next wave, so the victims will almost have to be the mega cap tech companies. But Steve didn't spend a whole lot of time on this, but he did share that these companies were doing a pretty good job investing in this next technology wave. And to me, that's a very important input because in our business, experience and having seen cycles really matter. And the fact that somebody like him, although it wasn't a scientific or a quantitative assessment, it was really more of a qualitative assessment, for someone like him to think that these larger players are actually doing a good job keeping up was actually a very useful input into my thought process. So I thought that was very helpful.
And Dan, as we edge closer to the end of today's show, I know that you've mentioned artificial intelligence. It's been a theme that has been highlighted across the speakers that we had on Market Insight this week. So any takeaways for you on AI?
Yeah, I mean, on AI, which obviously I have spoken about. I think I spoke about it last time, I spoke about it the time before. The most important takeaway from these conversations was, yesterday, Steve mentioned this briefly, but yesterday, or the day before yesterday, Nvidia and Accenture announced a partnership. right? And that to me, I think that to me is a very important announcement, very important partnership, because that'll really help Nvidia further strengthen its or further deploy its products and build out that installed base that I've talked about. What Accenture is the largest and probably the most influential IT consulting firm out there, and so Accenture is now going to help its corporate customers, its enterprise customers, figure out how to use Nvidia's capabilities, basically. What that means is Accenture is going to now go out and help its clients build applications, tools that they can use, and these tools and applications are going to be built on top of Nvidia's technology, Nvidia's software platform, which runs Nvidia's hardware. So software is among the best ways to increase the stickiness of your end users. And so now the largest tech consulting company is going to go out and help the largest, globally the largest enterprise customers build out applications on top of Nvidia that's going to be deployed and that'll be used by, you know, millions of workers, professionals out there. And once they get accustomed to using these tools, that's going to be a pretty, that's going to be a big advantage for Nvidia, even, you know, down the road, even if other hardware players figure out a way to make just as good, if not better, you know, GPUs. It's going to be pretty hard to penetrate that software installed base.
And Dan, I'm glad you focused on that announcement that came out between those two companies, because it does highlight some of the key points that you mentioned. So thank you so much for joining me on this Friday morning and for giving us a summary of our speakers and guests from Market Insight this week.
Thank you for having me.
Thank you, Dan. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamProTV. And make sure to check out the show anytime at your convenience on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here bright and early on Monday morning. So have a great weekend.